Welcome to the deep dive. We sift through, well, mountains of information, really, to bring you the crucial insights. It's your shortcut to getting well informed fast.
That's the idea.
So today we're tackling the sometimes pretty turbulent world of stock investing. We're focusing on this fascinating tug of war of ideas using market analysis and a trading plan from, let's see, May 28th and 29th, 2025.
Right. A specific moment in time.
Exactly. And our goal is to make sense of what feels like a really pivotal market moment.
Yeah, definitely. And we've got a good set of sources to work with. Think broad market analysis, but it also digs into key economic indicators. CPI, GDP, what the Federal Reserve's been signaling.
Okay.
Plus specific company earnings, TDD Holdings, that's Timu's parent news headlines, and then pretty detailed technical and sentiment analysis on specific stocks like NVIDIA, Apple, hims and hers, Supermicrocomputer, even AMC is in there.
Right, a real mix. So our mission today is really to cut through the static, understand these conflicting arguments right before, well, two potentially huge events. The release of the FOMC Minutes and NVIDIA's earnings.
Yeah, looming large.
What's so compelling, I think, is how the analysis lays out these very different potential scenarios, how these events could send ripples, maybe even waves, through the market and these specific stocks. We're kind of hunting for that aha moment, that clear clash of ideas about what might happen next.
That confrontation of viewpoints, yeah.
Okay, let's dive in. Let's start with the big picture. What was the overall market, the economic landscape these analysts were looking at?
Well, the analysis uses a couple of key tools here: Bayesian inference and scenario planning.
Okay, what does that mean in practice?
Essentially, they're constantly updating their, let's say, their understanding of the economy based on the newest information coming in. And then they use that to build out potential future pathways or scenarios, especially thinking about how the Fed might react.
Constantly reassessing.
Got it. So what were some of the most important pieces of economic data they were wrestling with?
Inflation was, well, predictably, a huge focus. The April 2025 CPI report, it showed some, let's say, encouraging signs on the surface. Overall inflation dropped to 2.3% year over year.
Lowest since early 2021, right?
That's right. And core CPI, which strips out food and energy, that came in at 2.8%. And this is the important part when you dig a bit deeper. Those really persistent costs, like shelter, services excluding energy, they stayed stubbornly high, like 4.0% for shelter year over year.
Oof. Still sticky then.
Very sticky. And actually, the Cleveland Fed's nowcasting tool, their real-time forecast, it was actually pointing towards a slight increase in the May CPI numbers, both headline and core.
So yeah, definitely a mixed picture. Progress maybe, but underneath, still problematic.
Exactly. Progress, but persistent underlying pressures, which gives the Fed cover to stay restrictive, right?
Makes sense.
Yeah.
And how was the Fed itself perceived? What was the thinking on their stance around this time? So the FOMC's statement back on May 7th, they kept interest rates unchanged in that 4.14 to 4.12% range.
Okay.
But what's really interesting is the language they used. They acknowledged solid economic activity, a solid job market.
Standard stuff.
Kind of. But they also repeated that inflation remains somewhat elevated. And even more importantly, they specifically highlighted growing uncertainty. They said, and I'm quoting roughly here, the risks of higher unemployment and higher inflation have risen.
Ah, okay. That sounds like a bit of a shift, acknowledging risks on both sides. More cautious.
Definitely signals heightened caution and, potentially hints at a more hawkish lean, focusing more on that inflation fight. Plus, they were continuing to reduce their holdings, their balance sheet runoff.
Right. Quantitative tightening still in effect.
Yeah. So all this made the upcoming FOMC minutes, the detailed record of that May 7th meeting, incredibly important. Everyone wanted to see the internal debate, the different viewpoints within the Fed.
Right, because the official statement is often just the consensus view, maybe papering over some disagreements. The minutes give you that peek behind the curtain.
Exactly. It shows you the discussion.
What else was catching their eye in terms of, say, company earnings or other economic activity data?
Well, again, sort of conflicting signals. You had TDD Holdings, Timu's parent company, report a pretty big drop in Q1 profit, missed revenue estimates too.
Okay, maybe a sign of weakening global consumer demand.
Could be. That was the suggestion. Then the first look at Q1 2025 GDP, the advance estimate, it actually showed a slight contraction, minus 0.3% annual rate.
Whoa, okay, how did that happen?
Mostly down to an increase in imports and a decrease in government spending. But it definitely complicates that Fed narrative of a solid expansion, doesn't it?
Yeah, contraction isn't exactly solid expansion.
Right. But then, here's the twist. The PCE price index, the inflation measure within that GDP report, it stayed high. 3.6% overall, 3.5% excluding food and energy.
Huh. So the economy may be shrinking slightly, but prices still rising quite fast?
Precisely. Underscores those persistent inflation pressures we talked about. But then you had U.S. consumer confidence for May take an unexpected jump, way up to 98.0 from 85.7.
Okay, that's a positive sign. People feeling better about the economy.
Seems so. And April's durable goods orders, while they were down month over month, they actually came in better than the really negative consensus forecast. Down 6.3%, but expectations were closer to -8%.
So still down, but not as bad as feared. Man, it really sounds like the data was all over the place, mixed signals everywhere.
It really was. A complex picture for the Fed and for the market to interpret.
So how did the market react in the immediate run-up to these big events, the FOMC minutes and NVIDIA earnings?
Well, there was actually a significant rally on May 27th. The analysis calls it a relief rally.
Relief from what?
Seems like it was sparked by news of a potential delay in some U.S. tariffs, specifically in the EU, and that surprising jump in consumer confidence we just mentioned.
Ah, okay. So reduced trade tension fears, plus maybe signs of consumer resilience.
Exactly. But the analysis is pretty quick to caution that this optimism might be fragile. The underlying concerns about sticky inflation and a cautious Fed, they haven't just vanished.
Right. So this rally could easily unravel if the news flow turns negative again.
That's the warning. If the FOMC minutes come out sounding hawkish, or if NVIDIA's guidance disappoints, that rally could evaporate pretty quickly. The core macro issues were still there.
Okay, so given that somewhat fragile optimism and all the underlying uncertainty, the analysts then sketched out a few potential scenarios for how the Fed might be leaning based on what those FOMC minutes might reveal. What did they see as the most likely outcomes?
They laid out three main possibilities. The highest probability, they gave it a 50% chance, was labeled hawkish Fed emphasis.
Okay, sounds like bad news for the market bulls. What would that entail?
This scenario suggested the minutes would show a strong consensus within the Fed about inflation still being too persistent. Maybe concerns that progress had stalled, and the discussion leaning towards fewer rate cuts in 2025 than the market was hoping for.
The market was pricing in a July cut at that point, wasn't it?
It was, yeah. So fewer cuts, or maybe even hints of further hikes, echoing some of the more hawkish Fed members like Bowman or Kashkari.
And a market impact of that.
Pretty clear.
Yeah.
Negative for stocks, especially growth in tech, stronger U.S. dollar, rising Treasury yields. A direct clash with that recent rally.
Yeah, that definitely sets up a potential sharp confrontation. Okay, what was the next most likely scenario?
Scenario 2, they gave it a 40% probability, was neutral data-dependent Fed. Basically, the minutes would just echo the cautious tone we already heard in the May 7th statement. Lots of talk about depending on incoming data, but no strong news signals either way.
So kind of kicking the can down the road.
Pretty much. The market reaction. Probably mixed at first, maybe slightly positive just from the lack of bad news, but then attention would immediately pivot to NVIDIA's earnings later that day. You'd likely see the market trade in a range.
Okay. And the least likely scenario? The long shot.
That was an unexpectedly dovish tilt, assigned only a 10% probability.
What would that look like?
It would mean the minutes showed more discussion about downside risks to economic growth, maybe greater confidence internally that inflation was definitely headed back to 2%, subtle hints of earlier rate cuts perhaps.
And the market would love that.
Presumably, yeah. Strongly bullish for equities, especially the Nasdaq and growth stocks leading the charge. You'd see a weaker dollar, falling Treasury yields. But given everything the Fed had been saying recently, they saw this as the least probable outcome.
Okay, so heading into the morning of May 28th, before either the minutes dropped or NVIDIA reported, what was the analysts' updated short-term view on the major indexes? S&P, Nasdaq, Dow.
They were leaning sort of neutral to slightly bullish on all three. S&P 500, Nasdaq Composite, Dow Jones.
So carrying over that momentum from the May 27th rally.
Largely, yes. And pre-market trading on the 28th was also looking positive. But they made a really specific point about the Nasdaq.
Which was?
That its direction was heavily contingent on the FOMC minutes, and even more so on NVIDIA's earnings report later that day. Its fate was really tied to those two events.
Got it. And just to make sure they weren't missing anything immediate, they had this fresh news filtering system. What were the key headlines hitting the wires in the, say, 24 hours leading up to 9 a.m. ET on May 28th?
Well, the biggest thing is obviously that strong market surge on May 27th, S&P up over 2%, Nasdaq almost 2.5%, Dow up 1.77%.
Setting a high bar for follow-through.
Exactly. And the drivers mentioned again were that Trump tariff respite for the EU and the jump in consumer confidence. Pre-market futures for the 28th were also strong.
Okay.
Then, of course, the two huge flags. NVIDIA earnings scheduled for after the close on the 28th and the FOMC Minutes release at 2 p.m. Eastern Time that day. Huge potential catalysts.
Anything else?
Yeah, Apple actually gained about 2.5% on the 27th, snapping an 8-day losing streak. Maybe some relief there. And that durable goods report we mentioned, down 6.3%, but better than the really bad consensus. Okay, so a lot happening, but all eyes really on the Fed and NVIDIA. Let's shift focus now to the specific stocks they picked out. What was the underlying logic, the sort of meta-reasoning behind choosing NVIDIA, Apple, HIMSS, SMCI, and AMC?
Yeah, it wasn't just random. They talked about reconstructing the stock's current relevance.
Okay, relevance based on what?
Based on a few things. Recent price action and trading volume, any significant news or upcoming catalysts related to that specific company, the overall market sentiment, how people are feeling about the stock and its positioning, like institutional ownership or short interest.
And they also tried to factor in the emotional drivers, right?
Exactly. Like what's causing excitement or fear around a stock. They called it an emotional catalyst trace, trying to understand the why behind the price moves.
Interesting. Okay, let's start with the big ones, the large caps. NVIDIA was obviously front and center. What was the analysis there? Well, its relevance was sky high because of that Q1 fiscal 2026 earnings report coming up after the close. Analyst expectations were, frankly, enormous, like revenue growth expected around 66%, EPS maybe up 44%.
Wow. All driven by AI.
Primarily, yeah. Their dominance in AI chips, the new Blackwell architecture, that big order supposedly from Oracle and OpenAI, even developing a modified chip for the China market despite restrictions, all fueling the hype.
And technically, sentiment, positioning.
Technically, the stock was up about 25% in the past month alone, closed around $135.50 on May 27th on huge volume. Options market was pricing in roughly a 6% move post-earnings.
So traders expecting fireworks.
Definitely. Analyst sentiment was overwhelmingly bullish, targets up at $160, $175, even higher. Lots of institutional ownership and very low short interest, only about 1%. Not many people betting against it.
And the emotional trace, what was driving that?
Pure anticipation for earnings, really. Excitement. Maybe some FOMO fear of missing out, driven by that powerful AI narrative. You could see accumulation happening before earnings, lots of call option buying, all reinforced by those high analyst price targets.
Okay, makes sense. What about the other large cap, Apple? What made it relevant at this specific moment?
Apple's relevance was more about recent potential negatives, specifically those tariff threats, the idea of maybe a 25% tariff on iPhones made outside the U.S. That had caused a dip, though it did bounce back somewhat on the 27th.
So tariff anxiety was key. Anything else?
Yeah, also looking ahead to their Worldwide Developers Conference, WWDC, coming up in early June. That's usually where they announce software updates and expectations were building around potential AI features.
Right, and the technicals and sentiment for Apple.
More mixed than NVIDIA. The stock closed just over $200 on the 27th. Volume was moderate. Sentiment was definitely shaped by those tariff concerns, created anxiety, uncertainty. Analyst ratings were more like moderate buy, not the screaming buy like NVDA. Short interest also very low, 0.73%.
And the emotional trace for Apple.
Fear and uncertainty triggered by the tariff news, definitely impacting thoughts about margins and pricing. The rebound suggested maybe those fears eased slightly, or maybe people were just looking past it towards WWDC and potential AI announcements. Attention was shifting.
Okay, let's move to the mid-caps they highlighted, the momentum plays. HIMSS and Hearst Health. HIMSS. Why them?
HIMSS was all about momentum. They just reported really strong Q1 2025 results, revenue up 111% year over year, beat earnings expectations.
What was driving that growth?
Their telehealth platform, definitely.
Hi.
But also their move into the GLP-1 weight loss drug market, offering compounded semaglutide, getting deals for Wegovy. That was huge news. Plus, they just raised almost $900 million through convertible notes for expansion, maybe AI investments. The stock was up like 127% year-to-date at that point.
Wow, okay. Strong fundamentals, hot market segment. What about the technicals and positioning?
Stock closed near $55 on the 27th. But the really eye-catching thing, extremely high short interest, somewhere between 32% and 36% of the float.
Whoa. That screams short squeeze potential, right?
Absolutely. Huge squeeze candidate. And retail sentiment, according to the sources, was extremely bullish. Analysts, though, were more mixed, kind of a hold consensus.
Interesting contrast. And the emotion.
Just sheer excitement and FOMO from those stellar earnings in the GLP-1 entry. But that high short interest added this whole other layer, a speculative dynamic, with bullish retail traders maybe actively trying to force a squeeze.
Got it. A very different setup from Apple or NVIDIA. What about the other mid-cap momentum pick, Supermicro Computer, SMCI?
SMCI's relevance was tied directly to the AI boom too, but from the hardware side, they build the servers, often using NVIDIA's GPUs. High demand for AI infrastructure was lifting them.
Weren't they also seen as a turnaround story?
Yeah, they'd had some past issues they seem to have resolved. Plus, they announced a huge $20 billion deal with someone called DataVolt, and Loop Capital had just put a buy rating on them.
Okay. Price, volume, sentiment for SMCI.
Closed around $41.50 on the 27th, up almost 4% that day on robust volume. Also had high short interest, around 25%, making it another potential squeeze candidate.
So a similar dynamic to Hims there.
Very similar, extremely bullish retail sentiment again. Analyst ratings also sort of mixed, leaning towards hold, though some were more positive, like Raymond James targeting $50. Lot to options activity, too.
And the emotional driver.
Again, excitement tied to the AI infrastructure narrative, SMCI's role in building it out, those big deals fueling hope. The turnaround perception helped, maybe a sense it was undervalued. And just like Hims, that high short interest added a speculative buzz.
Okay, and finally, the purely speculative pick. AMC Entertainment. Why AMC?
AMC's relevance was suddenly reignited by news of record attendance over the Memorial Day weekend. Over 7 million people, apparently.
Ah, the original meme stock stirs again.
Pretty much. It's got that huge, dedicated retail investor base. And yes, significant short interest, too, around 15% of the float, maybe 5 or 6 days to cover.
Still pretty high.
Yep. And lots of options activity, especially in out-of-the-money calls. Those are purely speculative, bullish bets. Retail sentiment on places like StockTwits, Wall Street bets, extremely bullish, just like Hims and SMCI.
And the emotional catalyst here.
Just that positive attendance news, renewed hope, maybe nostalgia for the meme stock frenzy, maybe just anti-short seller sentiment kicking back in.
Yeah.
You saw increased buying of the stock and calls, lots of social media chatter, all focused on that squeeze potential again.
It's really interesting seeing those pairings, Hims and SMCI with the high short interest momentum and retail fervor, and then NVIDIA and the broader market facing these huge, imminent macro earnings catalysts.
Yeah, and the analysis specifically highlighted that connection between Hims and SMCI, how a general risk-on mood, maybe triggered by good news from the Fed or NVIDIA, could act as a common catalyst, potentially igniting squeezes in both.
And the timing. NVIDIA earnings dropping right after the FOMC Minutes release. Talk about condensed volatility.
Exactly. A hawkish Fed read could definitely dampen enthusiasm, even if NVIDIA reported great numbers. But neutral or dovish minutes, that could clear the runway for NVIDIA to really fly, assuming the results were good.
While something like AMC just surges reflexively on attendance news, shows that sentiment feedback loop in meme stocks is still alive and well.
Very different dynamics at play across these selections.
Okay, so for each of these stocks, the analysts went deeper, looking at technicals, quant data, sentiment in more detail. Let's quickly touch on NVIDIA's technicals again. You mentioned MACD looked good, but RSI was overbought.
Right. MAD, the moving average convergence divergence, was showing strong buy signals across different time frames, daily, weekly, monthly, indicate strong bullish momentum. But the RSI, Relative Strength Index, was up in the 70s and 80s on those same time frames, which typically signals an overbought condition. Suggests the stock might have run up too fast, could be due for a pause or a pullback. The price was also way above its key moving averages, like the 50-day and 200-day, which is bullish, but again, maybe stretched. So yeah, a definite tug of war there. Momentum versus potential overextension.
A clear conflict. What about the quantitative data for NVIDIA beyond the low short interest? Options? Institutional flow.
Options open interest was really high, around the $130, $140 strikes for the May 30th expiry. Lots of bets being placed on a significant move. Institutional ownership was strong, but the specific source data didn't show any huge, unusual dark pool trades right before the snapshot.
And the sentiment loop for NVIDIA?
Overwhelmingly positive, as we said. Fueled by the AI hype, the earnings anticipation, it was a classic loop. Positive news, positive emotion, buying pressure, price goes up, reinforces positive expectations, rinse, repeat.
But with some underlying worries.
Yeah, potential China sales restrictions were a background concern, and some whispers about maybe margins coming under pressure eventually, but mostly overshadowed by the hype going into earnings.
And they ran AI simulations for NVIDIA earnings reactions.
Yeah, basically mapping trader psychology, strong beat and raise,
Yeah.
likely more buying, new highs, meet expectations but cautious guidance, potential sell the news event given the run-up, miss or significant guidance cut, sharp sell-off expected. Pretty logical outcomes.
Okay. What about Apple's technicals? More mixed, you said.
Yeah, Matty D was actually showing a sell signal on some time frames. RSI readings were varied, some suggesting maybe oversold, others neutral. Overall technical summaries from the source were ranging from strong sell to neutral. Even with that recent bounce, it looked like it was still in a short-term downtrend.
And the quant data for Apple. Low short interest, options around $195 to $200.
Correct. Significant open interest there. And recent institutional filings showed a slight decrease in overall holdings by the big players.
Sentiment for Apple mainly driven by tariff fears.
Primarily, yes. Fear and uncertainty were the dominant emotions noted. That bounce felt more like temporary relief. Eyes were really turning towards WWDC for any positive AI news to change the narrative. Social media sentiment was apparently pretty negative because of the tariff stuff.
Got it. Let's jump to HIMS. Technicals mostly bullish.
Predominantly, yes. MACD buy signal, RSI neutral to overbought, overall technical summary strongly bullish. Strong uptrend, though that RSI did suggest maybe it needed to consolidate a bit.
And the quant data for HIMS. High short interest, options showing more puts overall, but institutions buying.
Exactly. That high short interest is key. Options data showed a bit more put interest overall, but for the near term May 30th expiry, there was a big concentration of puts at the $55 strike. And yes, reports showed some big funds significantly adding to their HIMS positions recently.
Interesting. Sentiment for HIMS. Retail super bullish, squeeze hopes high.
Extremely bullish retail sentiment, driven by the earnings, the GLP-1 excitement, FOMO. And that high short interest just added fuel to the speculative fire, with bulls actively hoping for or trying to trigger a squeeze.
Okay. Super micro, SMCI, technicals were more mixed there.
Yeah, conflicting signals. Some MACD indicators suggested selling, but the RSI was indicating buy. Overall, summaries weren't consistently bullish or bearish. The stock had moved up recently, though.
Quant data for SMCI, high short interest again, active options, some institutions sell them.
Right. Another high short interest play, potential squeeze candidate, options active around $40, $45 strikes. And yes, some data showed significant reductions in holdings by certain institutions, which contrasts with HIMS where institutions seem to be buying.
Okay. And SMCI sentiment. Positive on AI turnaround, retail extremely bullish.
Generally positive sentiment, yeah. Driven by AI server demand, that big data deal, the turnaround perception, and again, extremely bullish retail sentiment noted in the sources.
And finally, AMC. Technicals bullish short term, but overbought.
In the very near term, yes. Look like a potential breakout from downtrend, buy signals for moving averages, MACD, but RSI was definitely flashing overbought.
Quant for AMC. Significant short interest, high call option activity, some institutions adding.
Yep. Classic meme stock setup.
Yeah.
Significant short interest. Lots of volume and open interest in those speculative out-of-the-money calls. And interestingly, some recent institutional buying noted as well.
Sentiment for AMC. Retail super bullish, reignited by attendance news, squeeze focus.
Exactly. That Memorial Day attendance news just poured gasoline on the fire. Renewed excitement focused squarely back on the short squeeze potential.
Yeah.
So what's really striking when you lay it all out like this is the direct conflict and signals for several of these key names, right?
Yeah, definitely. Like NVIDIA, you've got that clearly overbought RSI screaming caution, bumping right up against incredibly strong market sentiment, those bullish analyst views, the options betting on a big move.
Which signal wins out? That's the question.
And HIMS. You have that massive short interest, a huge bet against the stock, versus positive technicals and that intense retail bullishness. Is momentum going to force the shorts to cover, or will the weight of those bearish bets eventually drag it down?
A classic battleground stock.
Then at the broader market level, you have that strong May 27th rally, the positive pre-market feel on the 28th, flying right in the face of the Fed's ongoing caution about inflation and potential for more restrictive policy. Is the rally sustainable or just a temporary sugar high?
Yeah, those are the key tensions.
So how did the analysts try to, well, resolve these conflicts? How did they choose a likely path forward when the signals were pointing in different directions?
They really emphasize focusing on the most recent and potentially most impactful signal or catalyst.
Okay, so for NVIDIA, that would be?
The earnings report itself and the guidance. That actual hard data would likely override the pre-existing technical condition like the overbought RSI. The news trumps the chart, basically.
And for HIMS, with no immediate catalyst right then?
It would be more about watching the flow Broader market sentiment shifts, any changes in short interest data, signs of institutional buying continuing or fading, and the overall market's direction post-FOMC would be key.
And for the market itself.
The FOMC minutes were seen as the next big determinant. That would likely resolve the conflict between the recent rally and the underlying Fed caution, at least temporarily.
They also mentioned the role of surprise, right?
Yeah. Any big surprise in these catalysts? Fed much more hawkish or dovish than expected. NVIDIA wildly beating or missing could have a disproportionately large impact, really forcing a resolution one way or the other.
And they actually put confidence levels on their pre-catalyst views?
They did. For NVIDIA, they had low confidence that the overbought RSI alone would cause a decline before earnings, but high confidence that the earnings report itself would be the main driver after it came out.
Okay, for HIMS.
Medium-high confidence that the bullish momentum would continue in the short term, despite the short interest, maybe leaning towards the momentum side.
And for the overall market rally?
Just medium confidence. They saw a decent chance it could continue, but were clearly aware of the vulnerability to bad news from the Fed or NVIDIA, acknowledging the fragility.
This all then leads into the really actionable part, the specific scenarios and the trading plan. They laid out bullish and bearish cases for each stock.
Yeah, in quite some detail, with specific trigger events or data points that would signal one scenario playing out over the other.
Plus confirmation levels, price targets, stop losses, the works.
Exactly. Confirmation like price breaking above or below a key level on strong volume. Then price target 1, price target 2. A defined stop-loss zone to manage risk if you're wrong, and even an assessment of the risk-reward ratio and their estimated probability for each scenario.
Let's just quickly look at NVIDIA again as an example, the bullish scenario trigger.
The main trigger was a significant beat on earnings and revenue, plus strong forward guidance, especially for the data center business. Confirmation would be the price decisively getting and staying above $143 with good volume.
Targets and stop.
Initial targets mentioned were $150 and $154. Stop loss suggested around $136 to limit downside.
And the bearish scenario trigger for NVIDIA.
That would be if they just met expectations but didn't really wow, or if the guidance was weaker than hoped for. Confirmation would be the price breaking below $131 on heavy volume.
Downside targets and stop.
Targets mentioned were $121 and $115. Stop loss suggested around $137. Interestingly, slightly higher than the bullish stop, maybe reflecting expected volatility.
And they did this level of detail for Apple, HIMS, SMCI, and AMC as well.
Yes, all 5, providing these concrete potential trading plans based on how the upcoming catalysts might play out.
Now, beyond those direct stock impacts, the analysis also looked at what they called next-level effects or broader implications. What were some of those?
Well, for NVIDIA, they considered the ripple effect on the whole AI sector. Strong results could lift other AI-related stocks of sort of ecosystem impact. Weak results could obviously drag the sector down. They also mentioned the Oracle deal, potentially signaling more enterprise AI adoption.
Okay, and for the FOMC minutes?
The concern there was about market breadth. The rally had been pretty narrowly led by just a few big stocks. If the Fed came out hawkish, that narrow leadership could become very vulnerable. You might see a rotation into safer, value, or defensive sectors. Highlighted the fragility of the rally again.
Makes sense. Any other next-level effects?
They touched on that retail sentiment contagion idea. Like, could a big surge in AMC spill over and cause temporary pops in other heavily shorted stocks or meme names, creating mini bubbles based purely on sentiment shift?
Interesting. And they even summarized the pros and cons for each trade setup and ranked them.
Yeah, they used a table format advantages and disadvantages for each bullish and bearish scenario outlined in the plan. Then they ranked the setups based on net advantage, considering a balanced risk profile.
So, trying to find the setups that offered the best combination of potential reward, probability, and manageable risk.
Exactly. It seemed like they were leaning slightly towards conditional bearish setups for NVDA and AAPL, meaning bearish if the triggers hit, and maybe more towards bullish for HIMS, but again, all depending on those triggers and confirmations.
It really sounds like a very thorough attempt to provide a defined plan for navigating what was clearly going to be a very volatile couple of days.
Definitely. And they explicitly mention their process prioritizes the freshest data, essentially the last 24-48 hours, to avoid using stale information and making sure the logic reflects the absolute latest condition.
Okay, so let's try and synthesize this. Bringing it all together, it's crystal clear we had these really distinct opposing forces colliding right at this moment in late May 2025.
Absolutely. On one hand, you had the momentum from that recent market rally, driven by some positive news bites like the tariff delay and consumer confidence.
Butting right up against these two massive looming events, the FOMC Minutes and NVIDIA's earnings, both with the power to completely flip the script.
Exactly. And the bullish arguments were there. Maybe the economy is resilient despite some weird data points. The AI revolution is real and NVIDIA is king. And maybe these high, short interest stocks like HIMS and SMCI are poised for explosive squeezes driven by retail enthusiasm.
But the bearish counterarguments were just as strong, right? Inflation is still too sticky, the Fed might have to get even tougher, maybe crushing growth stocks, and the expectations for NVIDIA were just so high, wasn't disappointment almost inevitable? Plus, can meme stock rallies really last?
Those were precisely the opposing viewpoints. Will the Fed prioritize inflation or growth? Can NVIDIA keep defying gravity? Can retail sentiment overpower bearish bets? These were the sharp confrontations happening in real time.
And that's where the aha moment potentially lies for investors, right? Seeing these forces laid bare. The analysis, with its detailed plans and scenarios, really underscores how crucial it is for you, the listener, to have your own clear strategy. How might you react based on these outcomes, always considering your own tolerance for risk?
Yeah, this deep dive really highlights that interconnectedness. Macro events like the Fed, micro events like NVIDIA's earnings, and the psychology, the sentiment driving markets, it all weaves together. It creates opportunities, sure, but also significant risks, especially in the short term.
It definitely leaves you thinking, which side of these arguments feels more compelling right now? Which signal seems strongest? And perhaps more importantly, why do you lean that way? What's your own rationale?
That's a critical self-reflection, isn't it?
Definitely something for you to mull over. If you found this deep dive insightful and you want to stay plugged into these market shifts with our fast, frequent updates, make sure you subscribe.
Thanks for joining us.